When most people think about investing, they think about stocks. But there's another major type of investment that anyone can do, and that's bonds. Hi, I'm Roy with Lumocor. I teach the financial skills you probably never learned in school. Let's talk about bonds. A bond is essentially a loan that you make to a government, municipality, bank, or a company. When you buy a bond, you're lending your money in exchange for regular interest payments. And at the end of a set period of time, you get your original money back. That set period is called the maturity date. Now, the interest you receive is usually fixed. That means you know in advance how much you'll earn and when you'll be paid. Because of this, bonds are often considered more stable than stocks. But stability comes with a trade off. They typically offer lower returns. There are different types of bonds. Government bonds are issued by countries and are generally considered very safe. For example, US Treasuries, which are often viewed as some of the lowest risk investments available. Municipal bonds are issued by states, cities, counties, or school districts to help fund public projects like roads, schools, and utilities. They're often used by investors seeking income and relative stability. Bank bonds are issued by banks and financial institutions to raise money for lending, operations, or growth. They may offer different levels of yield depending on the strength of the institution and the bond terms. Corporate bonds are issued by companies to raise money for projects, research, production, acquisitions, or expansion. They may offer higher interest rates, but they also carry more risk. And here's something important: bond prices can change. If interest rates in the market rise, existing bond prices tend to fall. If interest rates fall, bond prices tend to rise. So, even though bonds are often more stable than stocks, they're not risk free. Their value can change when interest rates move, but risk can also come from inflation, credit quality, liquidity, early repayment, and changing market conditions. The key idea is this: bonds are designed to provide income and help reduce overall risk in a portfolio. They're not usually the fastest way to grow your money, but they can play an important role in balancing your investments over time. Clarity creates better decisions. Better decisions build a brighter future. Thanks for watching. See you next time.